Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, December 9th, 2022. S&P 500 currently sitting at 3961. I'm David Zarling. I'm here with Ian, not the offensive coordinator of Gamecock football, McMillan.
Sometimes I wish I could be.
I know. I hear you, man. But a great season by them.
You know, it's a good season. I think the bowl will be. We'll see. And then bowls aren't as exciting now.
I know, it's weird.
Because a third of your starting offense or defense transfers.
Transfers or declares.
Yeah. So.
And then they don't play.
Of course. Right. Like, so we're playing Notre Dame. Well, their starting quarterback is transferring. Like, he's not even. I mean, I don't know. I wouldn't go as far to say as now, like, bowls will kind of like get an asterisk compared to like generations past, but it's definitely not like this. It stinks that if you are, let's say you go to a bowl and you're playing a team with another like national star player, maybe like a Heisman finalist or something, or some guy, they're like, oh, this will be fun. Like, you know, this offense, they run an exciting, this team runs an exciting offense and they pass a lot, and it's a fun team to watch. And then, that quarterback is now declaring for the draft and the top two receivers are transferring. It's just not quite the same.
I agree. I think asterisk is a great way to put it, because all the points you just made.
And all the coaching changes that happen now.
Yeah.
I mean, all of this really used to happen after the national championship game. And now it's just, everything's been moved forward 2 months.
Well, and even like Neon Dion moving, right? And he's trying to coach his last game, but they don't want him to. It's weird. Like, the bowl thing is weird now. Totally agree. Let's talk markets.
Markets are still a little weird.
Yeah, I would agree. Down in the last week, using something like the S&P 500, still within painting the big picture, right? We're in an intermediate term downtrend, broadly speaking, broadly being things like the S&P, Russell 1000, NASDAQ 100. Intermediate means weeks to months time frame. But on a daily near-term time frame, we've had an uptrend since October. So we would call this, overall speaking, a counter trend environment, and that hasn't changed.
Was not able, I would say, on a shorter term, just sitting in this range, above 3900, 3920. I think we were above the 200 day for maybe like 3 days. And then that failed on, this Monday.
And is it really that easy? Is it really that easy that we come up into a 200-day, the average of the past 200 trading days, and this is where seller or supply outpaces demand again?
Mm-hmm. And a trend line resistance, right? From we connect all these. We talked about this last Friday. You want to go back from January, March, August. Early December 1st, all these highs, lower lows. I think, to your point, to use that phrase, like, will it be that easy again this time around? I would like to say no, but there's definitely some similarities.
Right. And it's all about gathering evidence, right? We know that for this A bottom, the bottom in October, we can call A bottom. For that to turn into the bottom, first we got to sustain trade above a 200-day moving average. And then a level we've talked about consistently for, it feels like a long time now, but really it can't be tremendously long. Long being greater than a year. 4180 on something like the S&P 500. Until we're above that, the environment remains that sellers have control, big picture. intermediate term, weeks to months time frame.
Yeah, it's going to take 180, I think, for me to be. Now, I mean, that's not 4,800. It's not blue skies, but 4,180, I think, does get you out into some
It's a major
open air. Yeah,
it's a major behavioral level. It was a consolidation phase that took place back in May. There was a false breakout above it back in August. And we reached that area, the bottom part of that range, 4070, 4075, 4080, whatever you want to call it, on something like S&P 500 cash. We reached that, which just so happened to coincidentally be where the 200-day moving average was. And we've since retreated. Now, will that retreat continue? TBD. We don't know these things. I wish we did, but we don't.
We didn't get any follow through. So now you're back to just the Dow is above its 200-day at this point.
And it's trying to potentially fail its August high.
Yeah, this 3,400-ish, 3,400.
Yeah. And then interestingly, I'd like to review a little bit with you. And I want to be careful because I know we've focused last week on 200-day moving average, and that's important because nothing really good happens below a 200-day moving average, and I still stand by that. The 200-week moving average is also something we've highlighted in the past. And if you go through, and I'm going to talk long enough so you can look each one of these up, but if you go through the major indices and you look at where we're at in that relationship, Russell 2000 could be closing below the 200-week moving average this week. Mm-hmm. The NASDAQ is just riding along it. It's kind of just hovering above its 200-week moving average. The S&P has definitely rebounded off of it. So it's going to be really telling in the next few weeks what this looks like in a seasonally strong period, right? We know the beginning of December is seasonally weak. We've matched that. The rest of December, and then going into the Santa Claus rally, which, by the way, people talk about the Santa Claus rally as if it's December. It's not. When we talk about seasonality and Santa Claus rally, that's something that really begins on the 23rd.
Mm-hmm.
It's the last 5 trading days of the year, plus the first 2 of the next. That's your Santa Claus rally period. So if we're seasonally weak or flat throughout the rest of this month, that will be some information on what this rally is.
Yeah, we're about halfway through, and I mean, right, as we're in a short-term uptrend, so I don't think it's fair to necessarily start dogging on, bulls yet here, but they have some work to do. And I think if we do get to Christmas or New Year's and it has been down or flat month, I think that's got to be a little disappointing based on what a lot of the, coming out of this October bottom and getting into November. I think it not having follow through in December would be a letdown, again, from a seasonality standpoint.
Yeah, for sure. If you're not matching the seasonal tendencies, and that's really how you should use seasonality, you should use it as a predictor. You should use it as, are we in season? Are we operating in season, or is there something different going on?
And and to your point, you like to point this out. You can't sit here and say on December 9th, okay, if we're flat or down, for the rest of the month, if we finish December flat or down, then, here's what I'm going to do on January 1st.
Right.
Yeah, it could, because, and again, to you, what my original point was, it's all about how does that unfold? I mean, if it's a nice sideways consolidation with some decently, let's say advanced decline, or, other breadth indicators are holding up, then that's not necessarily, does it go against seasonality? Yeah. Am I necessarily putting that in the, this was a bearish month bucket? No.
It's just counter to the seasonality, and you need to be open to the idea that further weakness could be ahead.
Now, yeah.
And then price has to confirm that thesis.
If December finishes down 7%, then that's another story.
Right. And that would be pretty significant, because December is one of the months that falls into the best periods of the year. And if you're going to be weak in December, that would be contrary to the seasonality, right? It's information. If you go out to the watermelon patch in July and there's no watermelons, that's information. Like if you go and you don't find stock strong in December or during the Santa Claus rally period or the first 5 days of January or January itself, guess what? You got to pay attention. Like, something's up here. I don't, what it is exactly, I don't know. But you're open to the idea that doesn't support a bullish thesis. You want to see seasonality play out. And when it doesn't, that's when you sit up and take notice. And so here we have an environment where November is seasonally strong. We saw stocks rally in November. So that matches the seasonality. And from a seasonal perspective, the year following a midterm election, regardless of who's president, which party's in power, is one of the best years.
Yes.
From a seasonal perspective, using a presidential cycle. So you got to be open to the idea that 2023 is going to be amazing. Could be. That's not a prediction though. And can't you almost like hear the keyboards typing and can't you smell the predictions for 2023 coming? Like you get.
They'll be coming out. They'll for sure be plastered everywhere here.
Yeah, the articles and predictions are going to be there, right? You're going to get your Barron's and you're going to get and that's all good and fine. They got a job to do, but everyone's going to come out with their predictions for where's the market going to be at the end of 2023. And it's crazy because no one knows. No one knows where it's going to end up. But yet we pretend like we know because it makes us feel good. Right? Someone asks you, where do you think the market's going to be at the end of the year? I could make up a number. And as long as the number's higher, oh, good. Okay, I'm good. As long as the market's going up, my prediction is up, it makes you feel good. So rare is the person who says, I think the market's going to be down in 2023.
Yeah, no one wants to be categorized as a negative. I mean, whether you're being realistic or not.
Debbie Downer, Negative Nancy.
Yeah.
Have you ever met Negative Nancy? Whoo, she's negative.
She is.
Yeah. And interesting, when you look at market characteristics that I kind of want to get your thoughts on, is when we look at early November and we look at the move from treasuries from early November on, it's a really interesting dynamic to see strength out of bonds, which is they had been moving in unison with stocks to the downside. And here you have from basically November 10th to now, you have something like treasuries up 10%, while the S&P from November 10th is flat. And from November 10th, now I know how special November 10th is.
It is.
Because I love you. It's your birthday.
It is.
And the dollar.
Some say God chose his greatest beings to be born on that day.
Yeah. And there's a pretty big breakdown in the dollar on November 10th. And so you're telling me the dollar is
So you
down.
think this is a pretty big inflection point, huh?
Yeah. The dollar is down 4.3% since November 10th, and stocks are flat.
It's a lot for a dollar. It's a lot for a currency.
It is a lot. The trade weighted dollar down 4.3%, and stocks are flat, and bonds are up. That is you just pause and think, that's different, because for how long it was supposed to be when the dollar gets weak, it's going to be great for stocks. And that's not really
been. That has been and I would say the same with rates, right?
Yeah.
Okay, so rates really started, they kind of had a double if we look at 30-year rates. And then lo and behold, Dave, what day do you think they made their big initial move on this recent downtrend?
Yeah, November 10th.
And that was supposed to be another one, right? So, I mean, growth stocks were supposed to start ripping as soon as rates go down.
Right.
And when I look at things like, I mean, Apple's down. Let's say your classic Apple down.
Yeah.
Down
Like-
about 2% since, what was supposedly the big headwind has been removed.
Right. You've got a weaker dollar. You're saying rates coming down, and that's supposed to be the tailwind for stocks, and that's not what we've seen. We've seen, for example, like small caps down 3%. You brought up Apple, mega cap growth. Like you said, it's supposed to be these rates come back in, and these tech is supposed to take off.
Look at ARK, right? The poster child for what lower rates were can do and have done for the market.
Yeah,
Down
great
8%,
point.
down 8% since rates started breaking down.
Right. And so are we shifting back into your traditional paradigm of we're going to buy risk off assets because what's gold done since November 10th? It's up 5%.
Yeah.
What has oil done since November 10th?
Well, and oil finally breaking a huge level. Golly, and I feel like it took us 2 months to do this at 75, 76, that area. The crude breaking a big letter. And we had seen gasoline had kind of given us a clue that oil was probably, gasoline futures broke before crude broke.
And so you're,
And that was supposed to be another one too, right? Oh, it's so good for the consumer, right? That's the most like odd thing, that lower gas prices must be a good thing for the average American. I'm not saying that's not. I mean, we all appreciate
lower gas
going to the gas station paying less, but that doesn't mean like like it's going to be some economic tailwind now because we're all saving $40 a month at Quick Trip.
Right, because who consumes the most of that type of energy? Is it the individual retail person, or is it the institution who's trucking goods across the country?
Yeah, I was going to say it's your retail, it's your distribution channels, hey, we're shipping these goods across the world, and then they need to be trucked from Miami to Seattle.
Right, and right.
That is where your demand comes from, not Jane saying, "Oh, now I feel more comfortable making this weekend trip because gas is 50 cents cheaper."
Right.
I mean, you may feel that emotionally, but you're not making a dent in,
Well,
and that goes back to the whole argument of if it's gonna be a demand side issue, this is what it could be in stocks, is there's just no demand. Like the economy is slowing, and I don't want to get on some big macro soapbox. It's not our thing, but it's just not always, quote unquote, some type of great sign for the economy and the consumer.
Right. One of the better phone calls, I don't think it was a phone call, actually. I think it was an in-person question that I got from my wife was, "Hey, I just paid X at the pump. What was it you said about be careful what you wish for gas prices?" And it opened this conversation about lower gas prices aren't always good and higher gas prices aren't always bad.
Yeah.
And pivoting back to, so oil since November 10th is down 20%. Gold is up almost 5%, and they're buying the yen. So when I think of like risk off things, again, markets aren't normal. They're the opposite of normal. So like never think about normal. But many times risk off characteristics in a market are we're buying treasuries, we're buying gold, and we're buying the yen. And that's what we've seen since November 10th. And stocks have been flat. And the dollar is down. And so there's some evidence playing out here that some of the more traditional norms of the market are returning.
Yeah.
Right? Because not all commodities are the same. For how long it was oil and some of the, softs and things like that carried commodities higher in the first part of the year. But here we are. And I'm going to say something. it's probably going to be, I mean, we've got to be close to oil's negative on the year.
Yeah, how about that? So the leading oil is negative. Energy stocks finally rolling over on an absolute basis.
Right.
Still, I'm pretty sure they've still got to be the best sector year to date.
Yeah. Yep, they are. But your point is valid. When you look at, okay, and that's another unique dynamic because Ian's point, energy sector is leading sector all year. November 10th.
It's probably been the worst since November 10th.
I was just going to say November 10th happens. So I've said that stocks are flat, and that's accurate when we look at the S&P 500 and things like the NASDAQ. Energy since that day is down 8, which is somewhat seasonally different because typically you see the best performer for the year only outperform in the fourth quarter or the final part of the year. And here we have energy selling off. So there's some, on the adaptive team, there's some raising of eyebrows because some type of foot dropped. And I know someone's going to point to like CPI or whatever. That's fine. I'm just saying when you look at price charts and the trends that had been in place going into early November, there's definitely some type of shift that's happened.
I'm going to say CPI just to create angst.
just to get me fired up. That's good. That's good.
Yeah, I mean, energy down 8, and you've seen other relationships like, well, Staples making new relative highs again. I mean,
yes, thank you.
I mean, there are definitely relationships that are starting to move in. You know, and the 3 best sectors since November 10th, Staples, utilities, healthcare, your 3 most defensive areas.
Right.
Financial, second worst, down 3% since then.
So there's a dynamic at play here where we're seeing buying of risk off parts of the market, asset classes that are risk off, while we run into the 200-day moving average, broadly speaking. And so you just have to be aware, right? When you see Staples breaking out versus the S&P, or Staples versus discretionary, and that's a harder discussion, right? Because I know we've got Amazon in the discretionary bucket, and that's kind of pulling that down.
But then the other side of the argument is, I mean, no one whines about that stuff on the way. I'm not saying you're whining, but like people do. Well, it's Amazon. Well, but it's been Amazon's overweight during the bull run, so I mean, you can't really have it both ways. But yeah, it's definitely a big weight. Google still looks bad, and
there's a way we can get that out of there.
You can
we can just use equal weight. And if we look at equal weight Staples versus discretionary, it's definitely still in a consolidation phase with a potential failed breakdown on
November 10th.
Close, November 11th.
Okay.
But the fact remains that something is up since the beginning of November.
Sure.
And this is all happening. I think the big clue is you still see dollar weakness. And that was supposed to be the tailwind. And stocks are flat.
And you've got rates. Well, and rates we've talked about 3, about 4 on long-term rates for, we talked about it when we broke through it, talked about how it could be a potential retest zone. It has been. And so far, I mean, this is day 1, it would need to follow through. I don't think you've changed the short-term trend at all, but you are finding yourself with a nice little bounce here. And it would be a logical spot.
And I would say too, and Ian and I are not here talking about these things as if we have a crystal ball or that we're somehow smarter than other individuals. And a case in point in this would be, I know on the internal discussions we've had here on the yield curve is just how inverted this is.
So nuts.
And I would love it, because I know there's people listening to this that are smarter than us. And so if you've got something and you want to email us, you absolutely can. Or you want to put something on Twitter, absolutely do it. Regarding, because the standard mantra is when this uninverts and moves higher, that's when we're going to, this is signaling. You'll hear over and over and over that this, where we're at right now, is signaling a severe recession. Is that a fair
I mean, the yield curve rubber band is, and again, I've got data in front of me that goes back to 1988. So I'm not going to sit here, and I don't want to play the like, well, actually in 1790, the yield curve was even worse. Like, okay, we're going to talk about this last, generation of bull and bear markets, the last 30, 40 years. Yeah, this is the most stretch it's ever been.
Well, and it's a great point, because I have a couple thoughts on this. So I understand the narrative is that this is signaling severe recession. Okay, so that's one thesis, that when we start to uninvert out of this, that's when the real pain is really, really going to set in. Again, that's one thesis, and I don't want to discount it. But we also have, to your point, Ian, if you look back to 1982, you see yield inversion like this.
Mm.
And what do we all know in 1982 as?
Yeah, it was a big flip in, entire interest rate trend, long-term trend.
Long-term trend in rates. Stocks rip from that point, like in a broad long-term perspective, months to years. 1982 is a significant year of stocks starting to outperform and rates starting to come down. It was the end of our interest rate cycle. So another thesis would be, are we just seeing a rate inversion like this and the vibration thereof because you're seeing a huge cycle end in lower rates? And you're going to now see higher rates from here. What that means for equities is TBD, but we know that it increases the hurdle rate. Meaning, go ahead.
Well, there's just so many things that are going to, if we are truly going to enter into a 30, 40 year, and I know we've talked about this before, if we're going to enter into a 30 to 40 year uptrend in rising rates, obviously it doesn't mean we're going straight up. It's an uptrend, just like rates didn't come straight down over the last 40 years. And there's just so many relationships and common, well-established theses around these relationships, intermarket relationships, that are going to get absolutely blown out of the water.
Oh, yeah.
And so I don't know if the yield curve stays inverted, but are all this has anything to do with interest rates that has been set in stone and embedded into everyone's heads over the last entire generation of investors and portfolio managers is all that now going to be the opposite?
Or different.
Or just different, yeah.
No, for sure. I think that thesis has to be on the table.
I mean, imagine if we go into rising rate environment, and this goes on for decades, what the mindset is going to be around. I'm telling you, you get up to 7, 8, 9, 10% in US Treasuries. That is a massive game changer as far as like, how willing am I to go into stocks if I can go get US government debt for double digits?
Yeah, if I can go get 7, 8%,
huge game changer.
Right, rule of 7, right? If I can go get 7% at a lower risk, then buying something that's a stock to get me that 7%, that's more risk because stocks are more volatile. So I got to get something greater. And am I going to go towards the things that are virtual and running on high leverage, or am I going to buy the things that are actually getting pulled out of the ground? And wouldn't that be ironic that you see a massive shift towards like physical, the companies that deal with physical things rather than digital things, when ESG is just at its peak?
Yeah.
Right. That's the narrative of the day, is this ESG stuff. And you're going to see a shift towards actually, wow, this company is valuable because they pull energy out of the ground.
I mean, imagine an era where debt
matters,
gets more and more and more attractive as the months and years go on. Like, right, because we saw it got less and less and less attractive for the when it went to, okay, I'm going to go into the market, I'm going to put my money into US Treasuries, and year after year after year. And of course, yes, there are counter trend moves, but you had an entire generation that over the course of their investing life got less and less and less and less on fixed income as it went along. And you entering, and I don't know, is my son even gonna care about stuff? Like, I don't know, like it could just open up a plethora of a brand new way, not just in investing and trading. I mean, I think from like a financial planning, I mean, it's just obviously for our firm, it would have a big ripple effect.
Well, and that's why we track
not
charts,
necessarily in
right?
the day to day, but it's in regards to planning and portfolio management.
Absolutely. And that's why our team is ready for it. And that's why we use charts, because yeah, in 3 years, it could be about bond laddering. It could be about how are we positioning portfolios for the certain yields that they're getting. And your son experiences the headline that says stocks are dead. And that's when that's when the cycle's changing, right?
Yeah.
He's 40 years old. Connor's 40 years old, and he's reading headlines about how the stock market's dead and everybody's got to be in bonds. It's a non-zero chance. And we know
People
these cycles
are scoffing, now the 60-40 is 60% fixed income,
right?
40%. I think that would be fascinating to, I mean, obviously you don't get to know until you're on the other side of it. But yeah, I think there's a massive shift. I mean, if you can go buy AAA corporate bonds for clients versus buying blue chip stocks, those same underlying companies.
For sure. And really, we've
Right.
talked in the past, it's just about the bonds have been in this downtrend. So you don't necessarily want to participate in a principal downtrend because that offsets the yield. We
Sure.
need you want to see these things start to stabilize, and then they're laddered, right? Some of these products start to ladder in the bonds with the higher rates, and you get to see that. Maybe November 10th was the start of that. The stabilization of bonds, because we've talked about in the past, we just want to see bonds stop dropping.
Yeah.
And this would be the first step. There's lots of work to do in the bond complex, but this would be the first stop, or first step in seeing a more stable rate of trend or consolidation to allow for the accumulation of fixed income without putting risk the yield because of the underlying principle.
Agree.
So it's a fascinating time, and we're Bayesian. We've said that how many times? As we get more information coming in, that will provide more clues. But it is notable to see stocks flat from that point, with the dollar down and bonds up. And
The first time you said that, my mom thought you said Asian. She texted me and she said, "You're not Asian." And I was like, "What are you talking about?" And she's like, "You said on the podcast, Dave said you were Asian." And I was like, "No, Bayesian." I was like, "Google it."
That's fantastic. I love Nan. Oh, shout out to her. Love that woman. I'm sorry that I didn't pronounce it's not me, really.
I hear it because I know what you're talking about, but yeah, it's just a funny side story.
No, it's good. And so if we could we'll wrap up shortly here, but in this potential shift that we're seeing, are there any other details that are catching your eye? And I guess what I mean is like financial, like sectors, like, are we seeing anything out of financials or semiconductors, right? Because semiconductors is a leader that we'd like to see lead. I could even pivot you to like, what's your thoughts on Dow theory, right? We had the Dow exceed its August high, but the transportation average didn't. And so you have this divergence.
Back below. So Dow transports quickly back below its, I guess it kind of consolidated there. Is that a foreshadowing? Is Dow transports a foreshadowing that we're seeing a lot of these consolidations in other areas?
So what I'm using for that is I'm using DJA for my Dow Jones.
Yeah.
And that actually did not exceed its August high, but if you take like a DJI, it did. The industrial average that exceeds. So DJI exceeds its August high. DJT, the transportation average.
Oh, I thought you were talking about.
Oh, Donald J. Trump.
Yeah, I thought you were talking about 45.
No, sorry. Got you all excited. But the DJT, the Dow Jones Transportation Average, doesn't exceed its August high. So you have in Dow theory, you have a divergence there. And so you typically like to see those things confirm that they're making highs together, or, if you're thinking it's downtrend, they're making lows together.
Financials, I would definitely like to see act better. Banks, again, these are things that don't have to outperform. And I know some people out there are probably saying like, oh my gosh, Ian, like how much can you expect out of these things? They've been rallying off the October lows, transports are up, 15 at one point, at their high, 22% off the October lows. And to that, my response would be, yeah, I mean, they do have to keep going. Like, sorry, this is the hole y'all dug yourselves into. Like, it's going to take a lot to get out of that. And yes, you do have to see, continued pushes higher. And I say lots of things are starting to roll over. Again, semiconductors, not yet. Transports are there. And you still, I mentioned staples earlier. Not something you necessarily want to see breaking out to new relative highs.
Well, I think it goes back to you said staples, healthcare, utilities. Since the beginning of November, they're the strongest. Bonds, gold, doing well, higher since the beginning of November. Stocks overall flat, dollar down. That is risk-off behavior. Now, whether that comes to fruition 6 months from now and we're lower broadly, I don't know. There's no way for me to know that. But if we're just in the court of law and examining evidence, that evidence is pretty damning. Like,
I agree.
But it's not a guarantee. Markets are never a guarantee. If you're looking for guarantees, go somewhere else.
I think it's interesting that this is all coming to fruition after we're, have already had a 25% correction.
Right.
This is what everyone thought was going to happen in January when stocks started going down.
Right. That's actually a really good point, because bonds have corrected in some cases more than stocks.
Mm-hmm.
And so you have the 60-40 portfolio is having one of its worst years on record, if not the worst, with the 60-40 down almost 25% as of the end of last month. I mean, that's supposed to be a fairly conservative, or at least an offsetting risk parity portfolio. And you're right. Typically, again, markets aren't typical. You get an equity correction, and bonds are holding some of that drawdown back, but they were worse than stocks. But now here we are I don't know if it's mid correction. I don't know what this is, but
yeah, I don't know what it is either, but
And now we're seeing a shift to where we're buying bonds, gold, and some yen, and staples and utilities, and
got my wife some yen for Christmas, believe it or not.
Yeah, I believe it. I did that for St. Nick's. Kids,
stocking stuffer.
Yeah, kids weren't impressed.
She can't spend it anywhere because we live in America, but
right.
I'll tell her that its value continues to go up.
It's pretty to look at. So we'll see. I mean, I know that CCC credit spreads are kind of flat. I know you've got a chart here on junk bonds.
Yeah, and I think, right, and bonds, I mean, these bonds got some work to do too. The rally the last few weeks has been nice. Bonds have some work to do. We'll see if this is day one of the next leg higher, which we won't know.
Well, and when you say
made a new leg higher,
you say bonds, there's more than just treasuries. Your chart here on junk bonds, it's a little bit higher since November 10th, but not to the degree that treasuries are. So there's more demand for treasuries than there is junk.
ICVT hasn't done anything. So,
and ICVT is a convertible bond ETF, and it typically those bonds are within the high growth tech
Yes.
software names. And so it's interesting to watch that just
They
meander.
look exactly like those stocks. I mean, those stocks haven't bounced really at all either.
Right.
They have on a percentage basis, but again, from a, people say, well, this bounced, it's up 25%. But when we look at it on a chart compared to, dates like November 10th or other big inflection points that are very obvious across all charts, those types of names definitely have not had very much strength. I mean, look at ARK.
Right.
ARK's sitting on year to, is this going to be weekly closing lows? No, but close.
And somewhat related to that early November scenario is when we say stocks are flat, I should be careful because I'm talking about domestic US.
Yes. Good
Okay.
point.
So when we look internationally though, however, and you look at Europe, right? And Europe was left for, out in the cold previously from a narrative standpoint. Europe's up 5%.
Great pun with the gas shortage.
Yeah. I try. Europe is up 5%.
Yeah, I mean, DAX, look at the DAX. You're telling me couldn't be a pretty strong longer term change in trend there?
Right.
I'm not saying it has to pan out, but it has cleared a lot more of its checklist from a technical perspective than a majority of US stocks and indices. That's
Right.
better than the Dow.
Exactly. And so you have this environment where, because remember 2003 to 2008, it was energies, financials, and international, specifically emerging markets. And not all emerging markets are the same, but are we open and minded enough to say, hey, we got some opportunities over here internationally? And again, they're not out of the woods by any means when you look at Europe, but that could be the initial thrust of demand on a relative basis for something like that. Not necessarily actionable, but at this point, and you could see a pullback in equities overall, and that would take Europe with it. But if it's showing relative strength through that, that would be huge information for probably the next few years. And we'll be ready to take advantage of it. Who knows, man? Maybe portfolios are some individual stocks through ADPV and we're long Europe and treasuries. I'm not here to tell the market what to do. All right. Anything else you want to touch base on before we roll out?
No, I think that's it. I think we've been pretty broad in our thoughts and coverage of what's going on out there.
Okay. Excellent. We appreciate everybody for listening again. As always, I'll always ask for you guys to give us a high ranking, as many stars as possible, especially if you enjoy this podcast. We put this out there. You guys don't pay a dime. And we put some work into this, and it's a labor of love, and we'd love to do it. One of the ways you can pay us, high ranking, share it with your friends. That gets the word out. We would love that. You guys take care.
Have a great weekend, everyone.